Welcome back to Talk Tickers. This is the show for the professional investor class.
Right.
We're here to basically strip away the fluff, ignore all the PR spin, and just get right down to the raw signal of the earnings calls that actually matter.
Exactly.
I'm your host, and I have spent pretty much the entire morning staring at terminal screens, reading footnotes, just digging through the filings so you don't have to.
And I'm here to make sure we actually interpret those footnotes correctly.
Yeah.
Because we have a really fascinating, honestly, and arguably contradictory print to get through today.
Absolutely do. Today we are doing a deep dive into the ticker Wing. That is, of course, Wingstop.
Right.
And let me tell you, if you were watching the tape this morning, the energy around this one is just frantic.
It's wild.
We are recording this right after the market has digested their Q4 and full year 2025 earnings. And the vibe check.
Electric.
Yeah, it is absolutely electric, which is, well, it's strange, honestly, given some of the headline data.
It really is a paradox. I mean, if you just looked at the headline numbers without checking the, quote,
Specifically the same store sales.
Exactly, the same store sales. If you saw that number in a vacuum, you might assume the stock was down, 10 or 15%.
Easily.
But the price action tells the real story here. The stock just ripped higher.
Ripped. We are talking up roughly 15 to 17% intraday.
Yeah.
It gapped up at the open and just kept running. It didn't look back.
It's a classic move, really. You look at your board, you see green candles everywhere.
Right.
But here is the thing, and we are going to unpack this extensively for you today. It was not a perfect report card.
Far from it.
Far from it. This feels like what we would typically call a relief rally.
Yeah, you really have to understand the setup going into this print. Because as you know, context is everything in this game.
It is.
The sentiment was, well, it was fearful. We've seen consumer discretionary stocks getting absolutely hammered across the board lately.
Right. The macro environment has been brutal.
We have seen other restaurant chains reporting severe traffic slowdowns. So the market was effectively pricing in a total disaster for Wingstop today.
Well, they were expecting consumer demand to just fall right off a cliff.
Right. The whisper numbers. Those unofficial expectations floating around the trading desks, they were grim.
Everyone was bracing for impact.
Yeah.
And then the numbers dropped and the market basically just collectively exhaled.
It wasn't just a sigh of relief, though. It was a realization.
Right. It wasn't a perfect quarter, but it was a thesis-affirming quarter.
Thesis-affirming. I like that.
The market looked at the data and realized that the long-term unit economics of this business are highly durable. Even when the U.S. consumer is visibly wobbling, the machine that Wingstop has built is still printing cash.
Still printing cash. And that is the signal we are chasing today.
Absolutely.
So here is our roadmap for this deep dive. We're going to break down that headline split. The revenue miss versus the earnings beat.
Because there's a big story there.
Huge. And then we're going to stare directly at the scary number, the same store sales decline, and explain why the market entirely forgave it.
Yeah, that's crucial.
Then we are going deep on the operational overhaul. The Smart Kitchen, the loyalty launch, and this massive unit growth engine.
And, of course, we will wrap it all up with our This Is Not Financial Advice segment.
Oh, yes.
I believe you have cooked up something interesting involving, what did you call it? Chicken math?
Chicken math, yes. I have a trade idea that is absolutely wild, but I promise the logic holds up. I'm calling it the Olympic speed spread.
I can't wait.
But we will save that for the end. Let's get into the results snapshot first.
Let's do it.
Okay, let's hit the headline numbers. Adjusted earnings per share, EPS. They came in at exactly $1.
A clean buck.
A clean buck.
Mm-hmm.
And the consensus on the street was 83 cents.
That is a massive beat.
Huge.
They beat by 17 cents. And honestly, that is the first real signal here. Profitability is the star of the show.
Right.
In a world where inflation is just eating everyone's margins alive, Wingstop managed to squeeze out significantly more profit than anyone expected.
Which tells you something about their cost controls.
Cost controls and their pricing power. Both are flexing right now.
But then, you look at the top line. Revenue came in at $175.7 million.
Right.
And the consensus was looking for $177.6 million. So a slight miss there.
A slight miss, yeah.
But overall, revenue is still up 8.6% year over year.
Let's actually clarify that for a second because I think it confuses people sometimes.
Good point. Go ahead.
Revenue for Wingstop is not the total amount of wings sold to customers.
Right, because they are a franchiser.
Exactly. They run an asset-light model. So revenue on their P&L is mostly the royalties and fees they collect from their franchisees, plus the sales from the very few restaurants they actually own themselves.
Correct. Which is why we also have to look at the system-wide sales metric.
Right. System-wide sales, which is the total amount of money flowing through all the registers, franchise, and corporate combined, that hit $1.347 billion.
Wow, $1.3 billion.
And that is up 9.3%. So the overall system is growing, even if the revenue recognition at the corporate level was a hair light compared to the Wall Street models.
Okay, but we have to address the elephant in the room now.
The scary number.
The scary number. The number that, honestly, in any other timeline might have tanked the stock.
Yeah.
Domestic same-store sales.
The comps.
The comps. They were down 5.8%.
Yeah. That is the scary number. And to put that in context for you listening, Wingstop has historically been a growth monster.
Absolute juggernaut.
This is the first same-store sales decline they have posted in 22 years.
22 years. Since 2003, they have been positive.
Right.
And suddenly, boom, down nearly 6%.
So if I play the role of the skeptical investor here,
Please do.
if I see a growth stock priced at a very high multiple post its first negative comp in 2 decades,
Yeah.
and the stock goes up 17%, I feel like I'm taking crazy pills.
Right.
Why did the market reward this?
Right. It seems entirely counterintuitive.
It does.
But it comes back to expectations and context.
Right.
First, like we said earlier, the whisper number was likely much worse.
Much worse.
The market was seriously fearing a double-digit decline. So down 5.8% was ironically less bad than feared.
Less bad is a powerful catalyst in a fearful market.
Exactly. But more importantly, you really have to zoom out. You cannot look at one single quarter in isolation. You have to look at the stack.
The stack, we use that term a lot on this show.
We do.
Let's define it clearly for the folks who might be newer to retail and restaurant investing metrics.
Sure. A stack is when you add the growth rates of consecutive years together to see the actual trend over time.
Right. It smooths out all the noise.
Yeah. Imagine you grew 20% one year, 10% the next, and then you shrank 5%.
If you just look at that last year, it looks terrible.
Exactly. It looks like a contraction.
Mm.
But if you stack them, you see the massive elevation change from where you started.
Right. And Wingstop had massive outsized growth in the previous years.
Huge.
If you look at the 3-year stack for Wingstop right now, they are still up 35%.
35% over 3 years.
They grew so fast, so hard, that a little pullback was almost mathematically inevitable given the current macro environment.
So the market is looking at that 35% growth over 3 years and saying, okay, the trajectory is still incredible.
Exactly. It's like sprinting a marathon, taking a breath for 10 seconds, and the crowd cheers because you didn't collapse.
That is a perfect analogy. And there is the good news that directly offsets that comp decline.
The margins.
Yes, adjusted EBITDA was $61.9 million. That's up nearly 10%.
And look at the specific margins. Cost of sales improved significantly.
Down 200 basis points, right?
Down 200 basis points to 75.6%.
200 basis points is real money. That is 2% of straight margin improvement falling to the bottom line.
It is. A lot of that is because bone-in wing costs are down, or at least stable.
Which is always the wild card for them.
Right. But their supply chain strategy is clearly working. And then there is the number that really, truly matters for the long-term thesis.
Unit growth.
Unit growth. They opened 493 net new restaurants in fiscal year 25.
That is a staggering number. Almost 500 new stores in a single year.
That is more than one a day.
More than one a day.
They ended the year with 3,056 restaurants total. The engine that builds these new stores is just firing on all cylinders.
And that right there is what the bulls are buying today.
Exactly.
Okay, let's pivot to our first real deep dive segment here. I want to explore this tension between the growth engine and the consumer.
The paradox of 2025.
The paradox of 2025, exactly.
Yeah.
Wingstop achieved record system-wide sales growth, 12% for the year, despite the fact that the individual stores, on average, sold less than they did the year before.
Right.
That is the textbook definition of a unit growth story.
It is. And if you are an investor, you really have to decide what you are buying.
What's the core thesis?
Are you buying the performance of the existing box? Or are you buying the proliferation of the boxes?
Right.
And right now, Wingstop is a unit growth story. They are opening more than one restaurant a day, on average, like we said.
Think about the pure logistics of that.
It's crazy.
Every single day, somewhere in the world, a new Wingstop fryer gets turned on for the first time.
And the pipeline is incredibly robust. They mentioned they have approximately 2,300 commitments.
2,300.
These are franchisees who have signed the contracts, paid the franchise fees, and said, I am going to build a Wingstop.
That backlog gives Wall Street visibility for years.
Years. It means even if the consumer is slow for another 6 months or even a year, the store count is going to keep ticking up.
And that drives the royalty revenue.
Exactly.
But let's talk about that consumer, because management was pretty candid on the call today.
They were. They didn't try to hide it at all.
No, they flagged the softness right out of the gate.
They specifically mentioned the low-income consumer and the Hispanic cohorts.
Right.
And these have traditionally been the core, the absolute bedrock of the Wingstop customer base.
Historically?
Yes. And those groups are hurting right now. Inflation, wage stagnation, the general cost of living, it is all severely pinching the wallet of the household earning under $50,000 a year.
We usually call this the trade down dynamic in retail, but in this case, it feels more like a trade out.
Trade out, yeah.
People aren't just trading down to cheaper chicken. They might just be cooking at home entirely.
Or they are just being very, very selective with their discretionary spend.
Right.
Wingstop is a premium product in the QSR space. It's not the dollar menu at McDonald's. It is an indulgent purchase.
Absolutely.
And even Wingstop is feeling the pinch of this choppy environment.
I really liked that management didn't blame the weather.
Oh, that's always the classic excuse.
It is. Well, they mentioned the weather briefly.
Mm-hmm.
They said there were 700 store closures due to storms in early 2026, but they didn't use it as the scapegoat for the whole year's comps.
No, they owned the macro reality. They frankly admitted the lower-end consumer is heavily pressured.
Yeah.
But and here is the silver lining that I think really kept the stock afloat today. The customer base is diversifying.
Right. They mentioned that the higher income households are stepping up.
The 50K to 100K and the 100K to 150K brackets, those are currently the fastest growing cohorts for them.
This is a crucial shift for the company.
Massive.
As Wingstop grows, it is moving from a slightly niche, urban, lower income skew to a much broader suburban middle to upper class staple.
And if they can capture and retain that higher income guest, they naturally insulate themselves from the economic shocks that tend to hit the lower end much harder.
It's an economic hedge.
Exactly. It's a built-in hedge.
It's the gentrification of chicken, if you will.
You could definitely say that. But it's also just our accessibility.
Right.
As they open more stores in more diverse suburban neighborhoods, the demographic mix is just going to naturally shift to reflect those areas.
Okay, let's move to operations.
Mm-hmm.
Because this is where the nerdy supply chain stuff gets really cool.
My favorite part.
We need to talk about the Wingstop Smart Kitchen, or WSK.
This is the operational overhaul that, quite frankly, does not get enough credit from the street.
They rolled this tech out to over 2,500 domestic locations in less than 10 months.
That is lightning fast.
Lightning fast for a franchise system. Usually, getting franchisees to agree to pay for and install new tech is like herding cats.
It really is. It usually takes years of pilot programs and arguments, but they got it done. And for those who don't know, the Smart Kitchen basically eliminates paper tickets entirely.
Right.
It is a fully AI-enabled kitchen management system.
So no more of those little thermal paper slips getting lost in the grease or falling on the floor during a rush.
None of that. It's fully digital. It's entirely data-driven.
Which is huge.
It manages the flow of orders perfectly. It tells the cook exactly when to drop the fries so they finish at the exact same millisecond the wings are done being sauced.
Wow.
It's pure synchronization.
And why does this matter so much? One word: speed.
Management is absolutely obsessed with speed right now.
They've issued what we might call the 10-minute mandate.
The 10-minute mandate, yes.
Yeah.
They want a consistent 10-minute ticket time across the entire system.
From the second you order to the second the bag is handed to you, 10 minutes.
Correct. And right now, they reported on the call that about 50% of their restaurants are hitting this consistently.
Okay, so that's essentially a coin flip right now.
Right.
But the ones that are hitting it, The data they shared is really compelling.
The payoff is very real. The stores hitting that 10-minute mark see significantly better frequency and customer retention.
It makes sense.
But the real unlocking mechanism here, the holy grail for them, is the lunch day part.
Ah, yes. Lunch is an entirely different beast than dinner.
It's completely different.
Dinner, maybe you're just chilling at home watching the game. You can wait 20 or 30 minutes for delivery. It's fine.
Right?
Lunch, you have a strict 30-minute break from your desk. If the food takes 20 minutes to make, you literally aren't eating there.
Exactly. Time is the absolute currency of the lunch hour.
Yeah.
By guaranteeing or at least consistently hitting that 10-minute mark, Wingstop suddenly puts itself in the consideration set for the busy office worker or the tradesman on a tight break.
Which is just a massive amount of white space in their revenue model.
Huge white space. They have historically been a dinner and late night brand.
Almost exclusively.
Right. If WSK actually works and gets that ticket time down, they become a viable lunch brand too. That essentially opens up a whole new business for them.
It's like moving from a chaotic short-order cook line to a highly optimized manufacturing assembly line. It's the industrialization of the wing.
It really is bringing factory-level precision to a fast, casual, fried food environment.
But there is a disconnect here.
Yeah.
This was a really interesting friction point they brought up on the call.
Yeah.
The kitchen is getting faster, but the delivery drivers are not.
The delivery disconnect. I caught that detail too.
Yeah.
Management specifically noted that delivery times are down 15%.
Which sounds good on the surface.
It is good, but they aren't matching the new kitchen efficiency yet.
Right.
You have the situation now where the food is ready in 8 minutes and it's just sitting under the heat lamp because the algorithm hasn't dispatched the Uber Eats driver yet.
Or the driver's stuck in traffic, or taking a stacked order.
Exactly.
And let's be honest, nothing kills the vibe of a $30 wing order like soggy fries.
Nothing. And Wingstop knows this perfectly well. They know product quality degrades by the minute.
So what are they doing about it?
They are working directly with the aggregators, the Uber Eats, the DoorDashes of the world.
Right.
They are trying to fix the dispatch algorithms via API integration.
Mm-hmm.
They want to sync the driver arrival time exactly with that new, faster prep time from the Smart Kitchen.
So the driver walks in right as the bag is being sealed.
Exactly. If they solve that, customer satisfaction scores naturally go up and repeat orders go up. It becomes a massive flywheel.
Speaking of flywheels, let's pivot and talk marketing and loyalty.
The big catalysts.
Because they have a massive, massive catalyst coming in 2026.
This is the lever everyone on Wall Street is waiting for them to pull, Club Wingstop.
But before we get to the club, let's briefly touch on the overarching brand campaign they mentioned. The Wingstop is Here campaign.
Right. They are actively pivoting their core messaging.
Yeah, focusing on center-of-the-plate occasions.
They don't want to just be the side snack you get for a party. They want to be the main course for a Tuesday night family dinner.
Although, speaking of parties, they certainly flexed hard on the Super Bowl metrics.
They really did. Record sales day, which we kind of expected.
Sure.
But the stat that completely blew my mind was the acquisition number. They acquired 100,000 new guests in a single day.
100,000 net new customers. That is a massive acquisition event.
Unbelievable scale. And even with that volume, the highest sales day in their history, average ticket times were hovering around 20 minutes.
For Super Bowl Sunday.
Yes.
That is incredible. I have literally ordered pizza on Super Bowl Sunday that took 2.5 hours.
Right. It really proves the Smart Kitchen capacity. The system didn't break.
It bent, sure.
It bent, but it didn't break. And that operational resilience gives management the confidence to really push the gas pedal on their marketing spend.
Which leads us perfectly into the loyalty program, Club Wingstop.
Here we go.
The national launch is slated for the end of Q2 2026.
We're getting very close.
And the pilot data they shared from the test markets was, well, frankly, it was startlingly good.
Very impressive numbers.
50% of active guests in the pilot markets actually enrolled in the program.
That is an exceptionally high conversion rate for a restaurant app.
Very high. But the behavior change is what actually matters to the bottom line.
Exactly.
Frequency increased by 7% among the enrolled members.
7%.
Now, that might sound like a small number to some people listening.
It does sound small if you don't know the math.
Right. But in the restaurant business, frequency is the absolute holy grail.
It is everything. If you can get a customer who normally comes in exactly once a month to come in 1.2 times a month,
The impact on the P&L is staggering.
it's massive. It is almost pure profit flow through at that point because your fixed costs are already covered.
And they also mentioned that retention for new guests was 30% higher in the pilot.
Right. So if you grab that Super Bowl newbie we talked about and you immediately funnel them into the Club Wingstop ecosystem.
They are 30% more likely to actually stick around and become a regular.
Exactly. And management was very careful to emphasize that this is not just a standard discount program.
Right. They aren't just doing buy one, get one free to artificially buy loyalty.
No, they talked a lot about emotional connection.
Swag, merchandise, early access to new flavors, experiences.
Because Wingstop has a genuine cult following.
They really do.
People literally wear Wingstop hoodies. The company wants to tap into that lifestyle brand energy.
It's essentially the supreme of chicken wings.
That's a great way to put it. They understand deeply that their core customers identify with the brand ethos, not just the physical food.
Okay, let's zoom out geographically for a minute. International expansion. Always a big topic. This has always been the next leg of growth story for them. People have been waiting for it. Is it finally happening?
I think it is finally happening. They opened over 100 international stores in 2025.
That is a record for them, right?
It's a new record. And they entered 6 entirely new countries last year.
The specific highlights they called out were really interesting to me. Milan and Paris.
The House of Flavor pop-ups?
Yeah.
They leveraged the Olympics in a very big way. They built these high-end experiential pop-ups in Paris during the Summer Games, and then they did it again in Milan.
And they're opening a permanent flagship store in Milan soon, correct?
Yes, very soon.
I just love the visual idea of these highly sophisticated Milanese fashionistas absolutely tearing into some lemon pepper wings.
I mean, it works. Flavor is universal. And they are successfully proving to the market that the brand actually travels.
Right.
It is not just a localized U.S. phenomenon anymore.
But the really big one they talked about.
India.
Ah, yes. India is the white whale of QSR growth.
They are actively targeting entry into India for 2026.
And they see a market potential of over 1,000 restaurants there eventually.
That is a massive TAM. Total addressable market.
Massive.
If they actually crack the code in India and get the supply chain right, the growth runway for the stock extends for another solid decade. Easily. And to support all of this global and digital scale, they have completely restructured their executive management team.
I noticed that. It's a bit of a nerdy corporate governance point, but it really matters to institutional investors.
It matters a lot. They brought back Raj Kapoor as the chief operating officer.
Raj is a heavy hitter in the industry.
He is. He knows restaurant operations inside and out. But more importantly, and this signals a shift, they created a dedicated commercial team purely for personalization and loyalty.
And an analytics center of excellence.
Right.
I mean, an analytics center of excellence. That sounds like a slide you'd see on a Microsoft earnings call, not a fast food chicken call.
That is exactly the point they are trying to make. They are intentionally structuring the C-suite like a modern tech company.
Prioritizing the data.
They are prioritizing data architecture, advanced analytics, and digital customer engagement over just traditional restaurant operations.
Right.
They are essentially screaming to the institutional investors, we are a scalable platform, we are not just a fried chicken joint.
Okay, let's bring it all back down to earth and look at the investor context right now. What does 2026 actually look like based on their guidance?
We touched on the guidance briefly, but let's really drill down into the numbers.
Okay, comps first.
Guidance is cautious, but I'd say realistic. 2026 comps are projected at flat to low single-digit growth.
Flat to low single digit.
Yes. They are telling Wall Street, do not expect a rocket ship recovery on the same-store sales line just yet.
Right.
They expect the trend to pivot back to positive growth, but it is going to be a grind as the consumer recovers.
But then you look at the unit growth guidance.
15 to 16% global unit growth expected for 2026.
Wow.
That is the compounding engine of this entire stock. That is the raw math that makes the valuation work.
Right, because if you grow your total unit count by 15%,
Even with perfectly flat comps at the store level.
your total system sales still grow by 15%.
Exactly. And your high margin royalty revenue grows by 15%. It's a beautiful model when it works.
They also guided SG&A selling, general and administrative expenses to be between $151 and $154 million.
Which includes some of those restructuring costs for the new executive team we mentioned.
And they are putting their money where their mouth is regarding capital allocation.
They absolutely are. They increased the dividend to 30 cents per share.
And they are very active in buybacks right now.
Yes, they repurchased out 248,000 shares just in Q4 alone.
Which tells me clearly that management believes their own long-term story.
Oh, without a doubt.
Buying back stock at these high valuation multiples means they think the stock is still fundamentally undervalued based on future cash flows.
They clearly see the disconnect between the short-term consumer noise and their long-term unit potential.
So if we try to sum up the ultimate bull conclusion here for the listeners.
The model just works.
Yeah.
The franchise demand is sitting at record highs. I mean, really think about that for a second.
Okay.
Comps are down negative 5.8%. Yet franchisees are still literally lining up, waiting years to build more stores. Why is that?
Because the individual unit economics are undeniable.
Undeniable. Corporate stores are actively running 20+% margins. Average unit volumes, AUVs, are sitting at $2 million per box.
That is incredible volume for such a small physical footprint.
It's an absolute cash-on-cash return machine for the franchisees. That is the ultimate safety net for the stock.
And the positive stock reaction today completely confirms that the market is willing to look past a temporary, macro-driven consumer dip.
As long as that store count keeps exploding.
Right. As long as the unit growth engine is running hot, the market will forgive the consumer engine sputtering for a few quarters.
That's the takeaway.
All right. We have thoroughly analyzed the print. We have dissected the operational strategy. Now, it is time for the segment that keeps our compliance lawyers up at night.
Oh boy, here we go.
It is time for This Is Not Financial Advice.
Mandatory reminder for everyone listening, we are literally just two voices in your headphones. We are not your fiduciaries. We are not your financial advisors. Please do your own diligence.
Do not trade based on what we say here.
This is purely for entertainment and hypothetical scenario planning only.
Okay, disclaimer out of the way. Here is the pitch.
Let's hear it.
I am calling this trade concept the Olympic speed spread.
The Olympic speed spread. I'm listening.
Okay, we have firmly established today that Wingstop is obsessed with velocity, right?
Right.
The 10-minute ticket guarantee, the fully AI-enabled Smart Kitchen, the optimized delivery dispatch.
All about speed.
They are turning physical tables, or rather delivery bags, significantly faster than almost anyone else in the industry.
Sure.
They are essentially trading on the velocity of money, getting the cash in the register and the food out the door as fast as humanly possible.
Okay, I follow the velocity angle.
And where are they choosing to launch their big international flagship stores right now?
Milan and Paris.
Exactly. High fashion, high speed, high density European markets, plus targeting India, the ultimate high density market.
Right.
Meanwhile, look at the rest of the traditional retail and casual dining landscape. What is the dominant narrative in those earnings calls?
It's a mess. Labor shortages.
Labor shortages,
Yeah.
skyrocketing hourly wages,
Incredibly slow service times.
drive thrusts that are literally backed up into the street, infuriating local zoning boards.
Yeah.
The old world of retail and dining is bloated, slow, and increasingly expensive to operate.
It's very sluggish, yes.
So here's the structure of the trade. You go long wing.
The fast chicken.
Fast chicken, exactly. You buy the speed, and you simultaneously short XRT.
XRT being the broader retail ETF proxy.
Exactly. Or, if you want to be more targeted, you build a custom short basket of heavy labor casual dining stocks.
The ones with massive physical dining rooms and armies of waiters.
Right. You short the slow, expensive models.
Yeah.
So you are essentially betting on what I call the smart kitchen arbitrage.
I actually really like the logic of this spread.
Right. Because it's market neutral in a way.
Exactly. You are efficiently hedging out the underlying macro consumer risk. Because if the U.S. consumer completely dies and stops spending entirely,
Both sides of the trade probably get hurt.
right, but you are isolating and betting purely on the operational alpha of Wingstop's tech stack versus the legacy players. It is a pure speed spread.
But wait, here is the outrageous kicker to the trade.
There is always an outrageous kicker with you.
Loyalty launch.
Yeah.
We know Club Wingstop is going national at the end of Q2 2026.
We do.
We know the pilot data is cracked.
Yeah.
50% enrollment rates, 7% frequency bumps.
Right.
So you use that known catalyst as a targeted volatility event.
Options.
Options. You buy out-of-the-money call options on Wing, specifically expiring in July 2026.
Okay.
You are aiming to perfectly capture the gamification of chicken pop.
The gamification of chicken.
Think about it. When those initial national loyalty numbers officially hit the tape during the Q2 or Q3 earnings call, and the street algorithms suddenly realized that average customer frequency just jumped from 1.0 visits a month to 1.1 visits a month.
The algo bots are going to go completely ballistic.
They will, because the math forces them to re-rate the stock.
It's wild. But honestly, it is not fundamentally crazy.
Thank you.
If that loyalty program actually moves the needle on national frequency by even a fraction of what the pilot showed, the valuation multiple simply has to expand to account for the new cash flow.
It is deeply asymmetric upside based entirely on a highly predictable loyalty catalyst. That is the pitch.
Well, as I always say to your ideas, wild, but extremely plausible.
Just do not bet the farm on it.
Never bet the farm. Maybe just the chicken coop.
Wow. We are ending on a dad joke. Okay.
I couldn't resist.
Fair enough. Let's officially wrap this deep dive up. Time for the quick recap.
Wingstop bits on profit, slightly misses on revenue.
And the market cheers the long-term durability and the massive unit growth pipeline.
The primary takeaway for me today is that they are technically selling wings, but they are internally operating like a Silicon Valley software company.
They are building a highly scalable platform.
Right. The smart kitchen, the digital loyalty, the data architecture, it all scales incredibly efficiently.
And the public markets absolutely love a scalable platform story.
They sure do. They pay a premium for it every time.
And before we sign off, here's one final thought for you to just sort of mull over on your own time.
What have you got?
We talked about the AI smart kitchen managing ticket times, right?
Yeah.
What happens when Wingstop eventually links that real-time kitchen capacity data directly to a dynamic pricing algorithm on their app?
Oh, wow.
Think about it. Surge pricing for chicken. If the wait time creeps over 12 minutes, the algorithm automatically bumps the price of a combo by 50 cents to cool demand, or discounts fries during a dead hour to drive immediate traffic.
Dynamic micro-pricing based on fryer load.
Yeah.
That is terrifyingly brilliant.
It's the ultimate end state of the tech company disguise. Something to keep an eye on.
Definitely.
Anyway, that is it for this deep dive into Wingstop's earnings. If you enjoyed this breakdown, please do us a huge favor. Rate, review, and subscribe to Talk Tickers on your terminal or app.
It really helps us keep the lights on and the data flowing to you.
Exactly. Keep your ticket times low and your margins high. We will see you at the next print.